Okay, this tutorial deals with how to complete the rental property information schedule if you own a rental property in Australia for your tax consultation. So the first thing to do is to hop onto our website, which is newtowntax.com.au, go to useful information, tax checklists, worksheets and templates, and you need to download the rental property summary schedule, not the quarterly income and expenses, but the summary schedule if you have an investment property in Australia. So you click open there, and it opens up a Word document. Fill your name, tax year that you're completing the information for. This is important if you're doing several years at once. You need to complete a separate worksheet for each year. So 2014 tax year, John Smith, the address of the property, U1 NUS Street, Newtown. The type of property is an apartment. Share of ownership is 50%. And you share the apartment with Jane Smith. It's important to record the share of ownership because when the rental summary is prepared in your tax return, then the distribution of either income or deduction, which is negative gearing, is split equally according to the ownership share. So the date purchased is information that needs to be recorded because it may be relevant in calculating any capital gain down the track. And if you've rented the property out for the whole year, then 52 weeks. If you haven't rented it out for the year, then you need to include the number of weeks that it was available for rent during the year. It doesn't necessarily need to be occupied, but it needs to be advertised at a market rate. And that's important because your deductions are claimed against the number of weeks that the property was held available for rent or rented. But for most people, it will be occupied the whole year, so we put 52 weeks in. If you have a holiday home and you use it privately, and some of the time it's advertised, say through Airbnb or through an agent that manages holiday rentals, then you need to account for the weeks that you were there yourself. So in this case, we've just elected to say that the property was rented out for the entire year. Now, many of you will have an agent statement which will detail the income and expenses that the agent has looked after for you. If you have an agent statement, you can start out by recording everything that's on the agent statement into the worksheet here. So typically, this part of the world, rent received $32,000. Property was occupied throughout the year. No other income. Water costs were about $800. Borrowing costs is something that we deal with. Body corporate fees, if you have a body corporate, you just look up those fees. Now, when you do that, it is important that you look not at the bill, but at what you've actually paid. If the tax office asks to see your records, they won't take any notice of your rates bills, your council bills, or anything like that. They need to see evidence that you have actually paid the bill within the financial year. So, council rates. Landlord's insurance is typically not something the real estate agent will deal with, so you may have to look that up yourself if you have landlord's insurance. Okay, property agents usually somewhere in the domain of 4 or 5%, so we've got fee for 2,400 there. And most importantly for most people is the home loan interest. Now, the home loan interest is not the home loan repayment. It's only the interest on the repayment that's tax deductible. So there are a couple of ways to go about finding that out. You can either look at your monthly statements and make the totals up for each month to work out the total interest for the year, or some mortgage lenders will provide you with the annual total either on a statement, or if you phone up you can find out. It's very important that you get that figure accurately, because for most people it's the largest deduction that they will claim in their tax return and the most likely deduction to be examined in the event of an audit. So interest on loan, The other thing here is that if you have withdrawn for any reason on that loan, for example, to pay for a holiday or a car, you need to let us know, because only the interest which can be attributed to the purchase of the property is going to be tax deductible, or interest on money that's been spent on renovations. So home loan interest goes in there, and then any repairs that have taken place, you need to itemize what they are. And the reason for that is that repairs which are essentially restoring the condition of the property to how it was when it was first rented are usually tax deductible straight away, but some improvements are capital in nature, which means you still get to claim the deduction, but it's spread out like butter over toast over a number of years, because the useful life of the thing that you've done is longer than a year. And if it was expensive to have the repair conducted, then different rules can apply to how it's claimed in the tax return. So you need to itemize any improvements, any repairs, and capital items, like, for example, a new water system, or a new set of plumbing, or new carpets. Anything that you have done to improve the property, you need to let us know what it is. And that's the basic information to compile the rental property schedule within the tax return. Now, there's also a possibility that you may be entitled to claim a deduction for depreciation. When you purchase a house, then the physical cost of constructing the house and all the fixtures and fittings are tax deductible over a period of time. For property, it's spread out very thinly, but it's a lot of money usually to construct a property. So that's something that you should definitely discuss in consultation, and maybe get in touch with a quantity surveyor like BMT Depreciation or DEPRO, both of whom operate nationally, who can conduct a survey of the house and probably give you an idea over the phone as to whether or not it's going to be worth getting a depreciation report to include those details into your tax return. So when you fill all those details out, you save that and submit it along with the other information in your tax questionnaire.